This is Jeff Wong for Dr. Wealth. Today, I'm going to talk about property investing in a post-COVID world. But first, a disclaimer. Opinions about property investing will be expressed in this video. They should not be taken as recommendations or investment advice. The views belong to the presenter and do not represent the views of Dr. Wealth. What happens after COVID? First impact is space. And many people realize that during pandemics and future pandemics, they have to work from home, which might be the norm going forward. And there will be lockdowns and repeated lockdowns in future pandemics as well. So a lot of people have this memory ingrained to them that I must have a bigger house, at least a house for a study room where I can install my computers and laptop screens and all that. So it is going to be ingrained in most people's minds that this day may come again. And so in most countries, people are moving out of studios, small apartments into bigger spaces where they can find houses or they can find 3 to 4 bedroom apartments to stay or to rent or to buy. So in many big cities, they have actually lost population. But I feel that eventually people will return. Take, for example, London. They have lost 700,000 people in 2020. That's almost 10% of the population. And a lot of these big cities worldwide, people are actually there to work. They're not from local areas. They might be from all over the country, but their ambition is to go to a big city to work and make their money. So New York lost 127,000 people, which is 0.65% of the population. In Singapore, demand increased in the rest of central region and outer regions as well, obviously to look for space. Okay, so the demand increased for houses, landed properties, 3 to 4 bedroom dwellings, apartments, houses. I feel that this is also, albeit a big shift last year, I feel that part of it is temporary as well, because once the economy opens up and shops and pubs are open, and people come back to work, eventually there will be a trickle back to the city center. So all these cities are actually great time to look at because their prices hasn't gone up, rents have most certainly fallen. So I can already see that there are people shifting back as they have to go back to the office. So the city center will slowly gain back its luster. But I feel that ingrained in most people is that this time around, I do not want a studio apartment. I don't want a small apartment of 1-2 bedroom. They are looking for bigger ones, just in case, okay? So next thing, money printing. Money printing is directly correlated to stock price, crypto, house price increasing. So the fact that in the last 10 to 12 years, Asia, ex-Japan, emerging markets, China, stock markets have lagged behind S&P 500. Even Europe has lagged behind them. The main reason, if you draw a line between money supply and stock prices, the stock indices tends to correlate very strongly with the balance sheet of the central banks. So you can see that in Japan, balance sheets are increasing, okay, because of money printing. You've got quantitative easing, and US as well. So S&P 500 has been one of the top performing stock markets in the last 12 years. So we have learned that it may not lead to greater inflation in terms of consumption, food prices, but it has gone up to asset prices. So especially things with fixed supply, we see houses gone up, outperform apartments in the last 12 years, even for Singapore, right? Bitcoin going up in prices. Anything with fixed supply tends to go up faster. So in the chart, you can see that nominal house price in OECD countries have risen faster than consumer prices or weekly earnings. And this is the impact of money printing. And I think money printing will slow down, of course, when the COVID wears off. But I think the prices will continue to rise as it outstrips the earnings. And another thing that happened during COVID, where most people last year was predicting prices to collapse, but the government has stepped in correctly with mortgage holidays. That means those who are servicing mortgages can stop doing that for 6 months, and that has led to no foreclosures. It's unlike the 2000 to 03 years where the banks actually ask the borrowers to top up their mortgages. So interest rates also fell to near zero. So workers also receive generous wage support. So in fact, in many countries, savings rate actually went up, which actually led to stock prices and property price going up. So there was no fire sale, in fact. So going forward in future, you can see that in the US, house price appreciates 60% since November 2012, the effects of money printing, and incomes have only appreciated by 20%, rents by 30%. So prices are outstripped income and rents. Construction of new homes, one of the biggest impact of reasons of why prices of homes actually went up is that there was no new supply, and everybody that's shifting out of the office, the central part of the city to the outskirts looking for bigger homes, cannot find anyone to buy and anyone to sell. And because of that as well, people who are already living in big homes are holding on to their homes. So, and new construction has actually slowed down because a lot of workers are in quarantine and material costs have actually gone up 30 to 50% due to supply chain disruption. So you can see that in Singapore, unlike in many other countries where intervention by the government is very little, Singapore's property price will remain affordable because you see the repeated government interventions to slow down the bubble. So in effect, Singapore's price appreciation averaged about 1.2 to 1.5% per year in the last 10 years. That's in general, including all residential property prices. We have seen in Singapore, core central regions underperforming, and you can see the outer areas have actually outperformed. So with the gradual opening up of the economy, I think core central region is the bargain of quite a good bargain. You can see that all apartments in Singapore central region going for 1,004, as cheap as 1,004, 1,003 per square foot to about 2,000, whereas it's almost similar to Pasir Ris for the new projects as well. So there's a lot more bargain in the core central regions because of the underperforming asset class. And again, this chart shows that houses continue to outperform apartments. And I think that with money printing, it will continue to do so as long as interest rates are zero or low. Okay, mortgage is cheap. People will borrow and buy what's rare, and houses are continuing to appreciate. Now, the day may come where interest rates starts to rise. I don't think that it's going to rise so much as most of the governments are quite indebted, and Singapore's interest rate follows more or less the OECD countries, and we were going to see continued outperformance of the landed properties until a situation where it's totally unaffordable, even for the top 10%. Okay, but it will continue to outperform as long as affordability is there and interest rates are low. So another area to look at is the 18-year property cycle. That the rise started in 2011, and we had a mid-cycle wobble in 2018, right? 2016 to 2018. After that, it was all systems go on the last 7 years. So we might see the cycle going up from 2021 to 2025. Be careful if you start buying in 23 to 25, because there is a time where you got to be very disciplined and the yields, the numbers must stack up. And if the property prices were to wobble or drop in the next 4 years from 2026 to 2030, you've got to make sure that you can meet your mortgage servicing. So go for cash flow positive properties, or at least neutral properties where you can get very good rental income and the demand is very high, because you might be caught in the winner's curse in the last 2 years where you buy indiscriminately, especially for negative cash flow properties, hoping that capital gains will make up for all that. So be very careful and very disciplined. Doesn't mean that you don't buy, but you just got to keep your discipline in the last 2 years of the cycle. In summary, work from home trend is here to stay, although I think people will start trickling back to office, but there will be an ingrained idea that, one day it could happen again and I want a bigger home. People want more spacious home, that's for sure. They will gradually shift back the city center, but I think it is too risky to buy apartments that are too small, studio apartments and 1 to 2 bed, because I think 3 to 4 bedroom houses will attract better quality tenants who stay longer. You attract lifers, people who actually stay there for many years, where they have families as well. So take, for example, if you have a studio and someone rents there, you were not going to stay more than 1 year. If they have a boyfriend or girlfriend, they will want a bigger home, and maybe it's a 2-bed apartment. And once they get married, start a family, it is probably a 3 to 4 bed apartment as well. So you want something bigger so that the family grows with you. So I feel that studios, 1 to 2 bed apartments will underperform. That's just my views. And landed homes will continue to outperform apartments as money flows towards assets with limited supply. So, and I feel that we should look at cities that have lost a lot of population, big cities, New York, London as well. And the core central region, for example, in Singapore, it has underperformed for many years. It is time to look at it as well. The rental yields are pretty high. You can get 2.5 to 3% rental yield net in the core central region. So one of the big trends that is likely to happen in UK, US, where houses are still affordable, and it's only about 5 to 7 times price to income ratio, prices are likely to outperform until the per square foot price is equal to apartment prices. So it's the same phenomenon in Singapore in the 1990s to 2010, where house prices in Singapore was $500,000 to $900,000. It wasn't that popular because staying in a landed home, you get a lot of, you may get some insect infestation, mice and all that. But in the last 12 years, it's outperformed apartments. And it will continue to outperform until landed houses and apartments per square foot is almost the same or even a slight premium. But in UK, you can get a house similar size for outside of London for as little as £200,000 for 1,000 square foot, whereas an apartment could be 350,000. And there's a big arbitrage. So there will come a time where the gap will close, because when you know houses will appreciate and outperform. So be greedy when others are fearful, and that is a very strong adage. I will show you. We actually, in fact, bought 4 deals from June 2020 until now. Let me show you 3 of the examples. First example, we did a flip project in July 2013, bought in Glasgow for 116,500. Okay, fees and refurb and taxes 23,500. Gross development cost was 140,000. We had a bridging loan of £100,000 at 8% per annum. Equity was 40,000. We sold it at 170,000. Net of cost, taxes is 165,000. Net profit 25,000. So we had the return bridging loan within 6 months plus interest is 104,000. Proceeds from the sale is 61,000. Return in 6 months was 52.5%. Annualized was 105%. So this is a flip project, which is buy and sell. Next, we bought below market value in Birmingham for 286,000. This is semi-detached. Fees and refurb was 54,000. Total gross development cost roughly about 340,000. Bridging loan was 200,000 at 8% per year. Equity was 140,000. Valuation report came out at 360. There was unrealized profit of 20,000. Money likely left behind after the mortgage is 54,000 because we are seeking a 75% mortgage. If that's successful, then money left behind is 54,000. Net rent after mortgage is 14,400. So return on investment is simply 14,400 divided by 54,000, you get 26.7%. But if you include the unrealized profit, it will be 63.7%. So our third project was buy to let or buy to rent on 24th October 2021. Okay, it was bought in Manchester for 230,000. And fees and refurb was only 10,000 because the condition was live-in and move-in condition. Gross development cost about 240,000. Bridging loan 140,000 at 8% per annum. Equity 100,000. Valuation report came out at 230,000. Money left behind likely after mortgage is 36,900. expected net rent after mortgage is about 11,000. Return on investment is about 30%. So how does it look like? So we were quite busy during COVID to do acquisitions. So if you want to find out more about how we approach things in a unique way, do join me in the webinar, and I'll see you then.